my tourism Pathshala, it will transform your dream into reality. Good afternoon, my dear student. This is our question paper analysis series. Through the question paper, we will develop our concept also. Today's topic is based on the financial management, the capital budgeting technique. The capital budgeting technique, in the previous question, they have given the matching based question, the term and meaning. There is a fourth term they have given. These are all related. The capital budgeting technique. Number one, time value of money. Number two, future value of money. Number three, present value of money. Number four, effective rate of interest. So first of all, time value of money. The time value of money is a concept based on the number one, the difference between the value of money receivable at present value of money receivable in future. The difference between the value of money, the value of money receivable at present and value of money receivable in future. The difference, time value of money, the difference between the value of present value of money and future value of money. Second, the future value of money is related the aggregate value of money at present and interest, at present and interest. Third point, the third option, the present value of money. Present value of money is based on today's value of tomorrow's money. Today's value of tomorrow's money. And final option, the effective rate of return. It is related the rate at which money held at present actually increasable in future. Effective rate of interest means rate at which money held at present actually increasable in future. So option number 2 is the right. A1, B2, C3 and D4 is the correct option. Now we are going to understand in detail about the various technique of capital budgeting technique. Good morning, my dear student. Before going to discussion the class, there is important information. We have already started UGC NEET and JRF coaching for tourism administration and management and paper 1 also. We will provide online classes, number 1, number 2, syllabus wise coverage, number 2, number 3, previous year solved question and analysis and explanation each and every question. I will provide also PDF note. There is a doubt clearing session and you also get the flexible class schedule. Student who have interest, you can join through this WhatsApp number 9123711814. Thank you. Good afternoon, my dear student. Today we are going to learn the financial technique, capital budgeting, financial management, another section, capital budgeting technique. The capital budgeting technique can be divided into two parts. Number 1, discounted technique. Number 2, non-discounted technique. So first of all, we have to, in my previous video, I have already discussed about the capital budgeting technique. The capital budgeting technique is basically the evaluate the long-term investment. When any investor going to invest, they have to think how much can return for his or her investment. That's why capital budgeting technique is a very important. The capital budgeting technique can be divided into two parts, discounted technique and non-discounted technique. Discounted technique can be divided into three parts. Number 1, net present value method. Number 2, internal rate of return method or IRR. Number 3, profitability. And non-discounted technique can be divided into two parts. Number 1, payback period. Number 2, discounted payback. Apart from another technique is a modified internal rate of return. Is a more realistic measures. First of all, we have to understand what is discounted What is discounted cash flow technique? The discounted cash flow technique, this method account for the time value of money. The discounted cash flow technique is the based on time value method. The time value method by bringing future cash flow back to their present value. That is called the discounted cash flow. And non-discounted technique, this method assess investment without considering the time. So discounted technique consider the time value of the money, and non-discounted method considering the without considering the time value of. Now we have to understand. Now we have to understand the net present value method. Net present value method. So net present value method is the present value of project expected future cash. This is a very important. The technique calculate the present value of project expected future cash flow, subtracting the initial investment. So future cash flow minus subtracting the initial investment. Give the positive result. Positive NPV indicate the profitable investment. So investor going to invest the project. Second important technique of discounted method, the internal rate of return. What is internal rate of return method? Internal rate of return, IRR. IRR is the discounted rate that makes the NPV or project equal to zero. Representing the project effect rate of return, and IRR, internal rate of return, higher than the firm cost of capital generally makes project portfolio. Well, IRR, if IRR result will come higher than the firm cost of project, then IRR generally make the project portfolio or investor ready to invest. Third part, the profitability index. What do you mean by profitability index? Profitability index, PI, compare the potential return of project to its initial investment. When I initial invest করলাম, what I initially invested, and potential return of my project due to its initial investment by dividing the present value of future cash. That is called the profitability index. Next thing is the non-discounted technique. Under this non-discounted technique, the payback period. This method determine how long. It takes for a project cumulative cash flow to equal the initial investment. The shorter payback period, when the payback period is short time generally preferred. So each and every investor time they won, whatever they invest should back as soon as possible or shorter period. That's why it's a payback. Next, discounted payback period. It is an important on the standard payback period. It accounts for the time value of money by using discounted cash flow to calculate the time to recover the initial investment. This is called discount payback period. And finally, modified internal rate of return is this technique provide more realistic measures of potential return by assuming that intermediate cash flow are reinvested at the time cost of capital. So these are the important method of capital budgeting technique. In my previous video, I have already discussed about capital budgeting, key aspect of capital budgeting. In this video, I try to identify discounted, non-discounted and modified internal rate of return capital budgeting technique. So keep touch with this channel. Step by step, I will discuss everything important conception. Without understanding this conception, only solve the question. It's very difficult to solve the question. So, my dear student, keep touch and follow and subscribe this channel. Thank you.